What's going on, everybody? Michael Silva here. Are you ready for the next big move in the stock market? I tell you what, you might not believe it. You might not believe it, but it is coming, and it is coming soon. That's what we're going to talk about on today's Stock Market Brief. I'm finally back in the office. Wasn't feeling all too hot. Had all kinds of things going on, but now I'm back. La 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 la. Let's move to the jobs report. So, jobs report, it was reported on Friday. The markets were closed. And what did it do overall coming into today's trading week? Well, you can see here, looking at the Fed Watch tool. For those that don't know, this is the Fed Watch tool by the CME Group. And allows us to see what is the futures market pricing in as far as the probabilities for a Fed rate hike. And you can see over here, it's currently at 475,500. And the probabilities of the next May meeting, we're going to be taking it up to 500 to 525. So a 25 basis point hike is what the market is saying the probability is. This is a big change here in recent days. So the jobs report comes out, and all of a sudden it's a really strong probability that, hey, the Fed, the yield curve will probably invert further, and the Fed is going to hold rates higher and potentially raise again at the next meeting. Now, I'll tell you what, it's still a very interesting landscape of the market, albeit everyone seems to know what they're talking about, but yet nobody actually has certainty or will share what they're doing while they are making their investments and trades. It's a very confusing market. And when you look at the meeting probabilities here, somebody's sniffing something out, that something's going to break, something's going to happen to really force the Fed to start lowering rates into the end of the year, which is right here, December 13th meeting over here. So, right, we raise and we hold, and now they're saying, okay, then right after that, we're dropping, and then we're dropping again. But as it stands right now, it says there's a probability that we're going to be 500 to 525 between May and June. Can that change if something happens? Obviously, that can change, and we'll go over some stuff that's probably going to adjust this curve here very shortly. Now, if we take a look at the yield curve, what happened to the yield curve when the jobs report came out? The 10-year 3-month is now 167 basis points inverted. This thing just keeps nosediving. We also had the 10-year and 2-year now at 59 basis points inverted. So as it was kind of uninverting here, where we had some turbulence in the market, it's kind of getting back to more deeper of an inversion. And when I look at something like the 10-year and 3-month, which was the Fed staple, apparently, right? It's been the 10 and 2, but then it became the 10 and 3, and then they always change when things happen. But you can see here, dating back to December 9th of 1980, it looked like we had a inverted yield curve, and this is the deepest inversion that I could find from this data source, long-term trends. It was 373 basis points inverted. And right now, as I stated, we're about 167 basis points inverted. So what happened in the overall market today on the jobs report? Well, okay, so the jobs report came out. Now, obviously, the market was closed. And then we came into a big gap down in ES, well, in SPY, in the SPX. We saw this big move down. But as you can see, the market started rallying up. It fell back off and scared people. And then we just ripped right back up. A very interesting type of price action. Very hard to fire off trades in this environment. And overall, I mean, where did we finish? We finished flat, right, on the day. It was the S&P 500 was up 0.1%, and it really got that final push towards the end of the day. So we really got to talk about, okay, where's the next big move going to be coming from? Well, we're going to talk about some technicals, and we'll talk about some potential catalysts that can create, obviously, that big move. So when I'm looking at the S&P 500 right now, this price action, I'm doing a little flag right here, right? We broke from this descending, broadening wedge, right? We're still in this channel right here if you draw this channel up. So as long as we keep in that channel, like things are good, the bias would be a little bit more bullish. But I want to remind you that this flag was also drawn out over here where it was a bullish consolidation, albeit we got a little bit higher. And we're seeing very similar price action where you get these gap downs and it closes at the high of the day. Then we got a gap down and close at the high of the day again. So it almost feels like it's like very similar to mid-February where we got some distribution and then it went lower. Let's go ahead and look at a couple of catalysts here as we're pretty much unchanged, obviously, on the week, just slightly up because today's the first trading day. And, well, we didn't really go anywhere. The one that finished the highest was small caps. Woo, small caps. Okay. What do we got going on for this week? So the data drop, what am I talking about? The macro data drop coming out. That's going to be Wednesday, April 12th, where we get that inflation data. Okay, we have FOMC minutes, but the main thing is going to be that inflation data. And then the following day is going to be the PPI data there. And then after that, we also have retail sales data, which is going to be another important one to watch, and consumer sentiment there, the preliminary as well. So it's a very macro heavy week that we're currently in. Even tomorrow we have Fed Kashkari and Harker both talking as well. So that's something to just be aware of, after this looks like at 4:30 p.m. So this looks like after market close. So we'll see here if that does anything to the overall market. But that's not it, okay? That is not the only thing that's going on as far coming into this week. We also have earnings taking place, and if we pull up the S&P 100 and we look at the big S&P 100s that are earning, it's going to be financials. You can see Wells Fargo, Citigroup, JPM. We have UNH, and we also have, which is not a financial, but then we also have BlackRock there too as well. Anything other prior to the big Friday right over here, we have, on Thursday, we have Delta. We have just a couple of them also reporting. Louis Vuitton, that's another one, right? CarMax, this... Yeah. Nothing too big up until Friday, in my opinion, but these could potentially offer up some good names to potentially trade, either an earnings type trade or intraday. You can take advantage of that additional volatility. Let's take a look at the dollar today. The dollar really showed some strength today. It was up 0.72, and it was kind of breaking from this downsloping trend line. And we talk about, as the dollar's been falling, what has the S&P 500 been doing? Well, go from this high, go straight down. What do you know? So the the dollar has been falling. S&P 500 has been moving up. Today the dollar was up pretty big. Okay, the S&P 500 was up fairly decently, albeit on pretty minuscule and just depleting volume. So it could be the volume is going to come in when we get these data drops. But I'm showing you this because the correlation has been very strong from the negative perspective. So if the dollar is breaking from this and is going to come retest this upper channel, that could put additional pressure to make this little flag that I pointed out earlier a potential fake out, and we could be in a period of distribution very similar to February where we start pulling back down. Now, if the dollar gets cracked and starts heading lower, that offers up the opportunity to pay back into gold, to look at that because it kind of came off today. But then also it might help perpetuate a move higher in the S&P 500. Now, we talked about the title of this video, right? It was Stock Markets on the Brink, what to expect on this data drops, okay? Because I didn't make a recap video, I'm going to go ahead and share you what I share with my Patreon group once a week. I give the weekly expected moves, okay? These are tracking about 40 products or so. This is the weekly close where it closed out last week, and then I have upper levels, lower levels, upper levels here, lower levels here on these products, and then I included 2 sigma levels too as well, so you could put those on your chart to watch to see where price could potentially go, because this is what the market is pricing in as far as a couple of things, right? So this was pricing in expected moves for the jobs report, right? So the market was closed on Thursday, but we knew that we had a jobs report, and then we also have all this other new data coming out here this week. So it's forward-looking risk, it's implied volatility, and these are the numbers, these are the levels that the market says, hey, this is where I think the risk is going to be, plus or minus, right? It's it could go up, it can go down. These expected moves going into obviously this trading week. Now, here's another one that I'd say screenshot. These are just the daily expected moves going into tomorrow's trading session. Today's trading session, the Qs, I believe, tagged the lower, went a little bit lower, and then started bouncing, coming back up from those levels. So these levels are just incredibly important to watch, because if you all of a sudden you see weakness into the lower level, right, 315, and you're like, okay, yeah, now I think I'm going to short it. Yeah, you can get luggy and you might see a 2 sigma move. Okay, but you can also get your face ripped off, as we've seen prior on the last 2 trading days. The Qs came into the lower expected move, and then all of a sudden it ripped back up more north of the upper expected move. So these are important to have on your screen, and I'll show you what they look like on the 15-minute time frame momentarily. Let's take a quick look at Bookmap. We're going to look at ES. I like to show this on Bookmap because it shows levels after the close. It shows the order book, right? So it looks all crazy and cool on the screen. It shows cumulative volume delta, or delta volume, by these green dots here. So as they're green and they get bigger, it just shows that there's more buyers versus sellers. And what I add on here is I do the upper expected move for the day, which is 41.65, the lower, which is 4115 there. But then I also want to call out a couple orders that are, decently sized after the close. And you can see here up at 41.75, there's some orders hanging out over here. So that's going to be an important level to watch going into tomorrow. And then beneath us over here at 41.05, this has been actually a very interesting level as prices came into it today a couple of times. And it's been kind of like this magnetic kind of pull into, you know, just if you look at this level across a longer term ES chart, price action has, you know, broken from that level and then sucked right back in, and broken further from that level and then sucked right back in. So it's going to be an interesting to watch. If we say come outside and tag here, we might bounce back into the expected move, because 68% of the time it closes within there. That could be a statistical type of trade. Or we might come up here to 41.75, right? And then all of a sudden we suck back down into the expected move. Could be a couple of ideas. If we're above the daily VWAP to start the day, you might say, okay, as long as we're above the daily VWAP, I'm going to look for pullbacks and buy strength and try to play into the upper. And vice versa, if we're below the daily VWAP and it's starting to move down, you say you might want to sell into strength as long as we're below the daily VWAP, and play down into the lower expected move could be a potential option. Now, by the way, Bookmap offers all my subscribers a discount, which I always pin that onto the pinned comment. If you want to check more about Bookmap, I use them all the time for intraday trading, more specifically. Now, if I take a look at the SPY on the 15-minute time frame, you can see this is what I mean by very weird price action, but it's bullish, right? We gap down and then we close north at the high, right? We gap down and we close north at the high, Now we reclaimed the month to date and the 5 DMA, which is the 5-period moving average just on a 15-minute chart here. So it's the 130-period moving average. If we take a look at these white lines, the white line represents the upper daily expected move. The lower is the lower daily expected move. So I would be looking down here, you know, obviously be a little careful if we came in down into this area, because we'd be back below the month to date, we'd be back below the week to date, and we'd be back below the 5 DMA. So if that were to take place, yeah, we can see a bounce, but if it doesn't recoup that level, and it starts rejecting from the month to date and the 5 DMA, that can open the door to potentially see a move obviously lower into the potential lower weekly expected move. Remember, the weekly expected move is what the options market is pricing in as far as forward-looking risk, and that includes all those macro data drops. As it stands right now, this move has opened the door to come up towards the upper expected move, right? Because we're above the week to date, which was today's daily VWAP. We're above the month to date, and we're above a starting to neutralize 5 DMA. So it is inclining, but it's starting to get flat. So as long as we stay above this level, this will start turning up and give us opportunities to play into the daily and play us into the upper weekly expected move too. So as it stands right now, price action is bullish, but if you look to the left of the chart, where have we gone since, you know, March 31st? Well, we've been just sideways overall. So it's choppy. You got to be patient. You got to be aware, right, of what's going on and how price action is, you know, working itself at these specific levels and so forth. Take a look at the Qs, very same situation, right? We gap and we rip, we gap down and we ripped. Okay, that's 2 days in a row. So it's good to see them breaking, you know, the bulls stepping back in and reclaiming the 5-day moving average, the month to date. But just remember, we're not too far off of it, and it's starting to neutralize and come down. So we need to hold the level, you know, and the longer we hold it, it starts curling itself back up and opens the door up for the upper weekly expected move. Okay, if we start getting a hit to the downside tomorrow, obviously pay attention to the week to date anchored VWAPs on both the Qs and the SPYs, because that can act as a potential area of support, right? We broke down today, we came back, we back tested on that kind of big hit to the downside, and you could see it held as support, and we started bouncing back up from those levels. And this happened to actually also be right around that daily expected move for the Qs. Now we're going to get into some indicators here momentarily. The zones is something that I also share on the Discord channel, and I showed it here, and the last time I shared it, it looked like this. It was all red, okay? It was red, and basically that told us, if you know what the zones are, think of it as a very advanced Bollinger Bands. You have a high level, a low level, and you have a midpoint, and the higher price gets up to the upper band, this lights up red, okay? And it just allows me to see multiple sectors and products and assets that are overextended. So when this was bright red, we said, hey, pause out here. Like, this was a few days ago, right? Or, you know, or earlier last week, I think. And it tells us, hey, you know, price may need to consolidate or could potentially pull back, but it's not the place that you really want to push from the long side. Well, let's take a look at what it looks like now. As you can see, we started consolidating, we started pulling back, and this gave us some insight. So it started cooling off. Now, from a bullish perspective, if you look at the midpoint, okay, and then you look at the close of the day, you can see, we'll just use the S&P 500, for example, the SPX, we closed at 4109, and the midpoint's at 4067. So the midpoint, it's moving up when that can act as a, you know, potential think of it as a moving average in a way, but it's not that, but think of it like that. And this can act as a potential support area. So price is still above an inclining midpoint. It's when we start breaking this level, it opens the door for the lower range, and then you'll start lighting up green here on the screen. Very similar to like TSM, how this is green because that took a hit today, but it started actually bouncing back up. The one that's bright red on the screen is obviously Bitcoin. Bitcoin after hours is starting to move up here, and we're going to use that into the leeway of the indicators. And the first one we're going to talk about is the Saylor to Schiff tool. The Saylor to Schiff tool allows me to track the rate of change between Bitcoin and gold. Okay, this tells me really a high risk asset, high beta asset versus more of a safe haven asset, which is gold. And you can see the red lines are on the screen are marking the times that we cross beneath a rate of change of 0. So when we cross beneath a rate of change of 0, and there's some stipulations to this. If you haven't watched this video, you can go watch it, how I show you how to build it, make it, and how I personally look to use this. But you can see it triggers, and then we can see some selling activity. It's caught in every single big move to the downside. It's by no means a holy grail. It's been working great, but things come to an end at some point. The last sell signal was right here on this week, and you can see it whiplashed back up very quickly. But what you can see here is on that move, it actually had a big hit down from 22,000 down to under 20,000. So it was a big hit to the downside that it caught and warned us of. And then it flipped right back up to a buy signal, and it caught this move up here, and now it's currently trading at about 30,000. The reason why I'm showing you this right now is because the rate of change between Bitcoin and gold, although it's just a Monday and you want to wait for this to actually close at the 0 at the end of the week, on the closing weekly candle of Bitcoin, so we have a lot of time, this could change, but it is starting to point down to that 0 line right here, the rate of change. So we'll continue to monitor that and see if, hey, if Bitcoin starts bumping up to the upside, and then all of a sudden, gold takes a little bit of a pause, and then this could turn right back around, and this can continue to move up. Or you can potentially say, hey, I'm starting to see this move up higher. It's coming into some, psychological levels, 30,000. It's potentially coming into prior breakdown area, right? So we had this, advanced head and shoulders right here. We broke down. We're coming to back test it. So we're coming into resistance. The rate of change is coming off. Hey, maybe I might take a little bit of profits here. And then see if it consolidates a little bit more, or look for a better entry, or wait for the next buy signal. However you look to do it is completely up to you at this time. The next one I want to talk about is the tips over treasury bonds. We talked about this being triggered just recently. They're coming into April, and this sometimes gives us insight into a potential volatility to come. And well, you can see volatility has risen from that point. Even today, actually, it came off quite a bit, but volatility started the day pretty high. It ended up finishing up 3.1%, and that is on the VIX. So you can see here, it has triggered. It's starting to point back up again. We don't know how high it'll go, or how long it'll stay elevated. And then when it starts going beneath the green line, which is -2%, we've actually seen volatility subside, and it's been a pretty helpful indicator, giving us some heads up. Another one that I paired this with was just the zones. I use the volatility tab when I send this out to the group. But these were all bright green too. So they were all at the lower range of, the VIX price was trading down here, but it wasn't just the VIX. It's also like NASDAQ volatility, Russell volatility, and all the other volatility products that I look at. Now let's take a look at the summation index. The summation index, we did have that potential change in trend take place, and well, what do you know, the market's been up from that point. It's rather flat over here, so we'll continue to monitor this. If we get the weakness, this looks like it could potentially just turn right back around, and the parabolic SAR can give us a heads up notice again, saying, hey, the trend, it was a very short move, but it might start heading back down. That's not the same story with the NYSE summation index, which I'll show you. But before I do, I want to show another piece of the NASDAQ Composite. And you can just see here the percent of stocks above the 200-day moving average. You can see price moving higher, but the percent of stocks above the 200-day moving average in this entire composite, the NASDAQ Composite has 3,000, 3,500 stocks, I believe, that's in it. You can see breadth is waning here. So it's being held up, propped up by a very few amount of stocks. And that's not really the greatest sight. You'd want to see breadth participating in this rally. And by the way, on a flip side of this, that opens the door for breadth to start participating, to start moving the market higher. So that's always a possibility and a way to look at it as well. Okay, another thing I look at is growth versus value. You can see we did switch that 10 period rate of change which tells me sometimes that can bring weakness into the Qs. So I marked it a couple of times here where you can see where the rate of change crosses down below 0, and you can see the market sometimes heads down from those areas. It's marked this bear market top right over here, and it's marked this bear market rally top there too as well. And you can see it did hit a couple of times here, and we started pulling back and consolidating. So this could turn back up. That can be a positive sign, but the RSI was getting overbought. The rate of change was getting overbought. We had some negative divergences forming, and now we finally clicked back down, starting to consolidate, but it could still give us, it could be still telling us that, hey, there could be some more downside here. As I stated, the NASDAQ summation index, broad index here too as well. This one's still pointing straight up, and this one has made a nice big move from that bottom. One thing that I want to include onto this is also the advanced decline line. If you look at the advanced decline line, you can see we had a low and a higher low. Well, price right here was putting in a low and a lower low. So it was telling us at this time that there was a positive divergence. So as price was going lower, the internals were actually getting stronger. And that gave us insight to saying, hey, we can potentially see a rally here. And that paired very well with other indicators like this trend change over here on the summation using the parabolic star. Now, what I want to just call out here is this has been an area of resistance on this chart. Boom, 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 and it also acted as an area of support. So if the advanced decline line starts pushing back up into this area, we got to pay attention to where price may go, if it falls or if it goes up and follows it, because as we come into this area, we'd want to see this break out to be bullish, but a breakdown or a negative divergence would be technically bearish. Another trend line to watch is obviously this low, and this low. They're bouncing perfectly off of it. So if this starts breaking to the downside, I'd be very hesitant to be long on the New York Stock Exchange, just because that could open the door for some more downside there as well. The last one I want to talk about is the copper ratio to the S&P 500. Sorry, not ratio. It's really just looking at the price of copper over the S&P 500 right here. So S&P is down here, copper's here. When copper makes a lower high while the S&P 500 makes a higher high, it has marked a couple of divergences, like all the red lines you can see where the S&P 500 dropped, it dropped, it marked this bear market rally top, it marked this bear market rally top, and it's done it multiple times. On the flip side, the blue shows us when copper finds strength while the S&P 500 goes lower. That's marked that bottom, it's marked this bottom, and it goes higher. I'm just calling it out because today we had an outside trading candle while the market kind of pushed higher, and we've had that negative divergence forming. We talked about it, and now the market's just consolidating. Either it's going to flag out and work itself out, total possibility. As you can see though, it has already somewhat played out to the downside, but if copper keeps getting hit to the downside, this could be telling us, a heads up notice that the S&P 500 very well may follow, as well as other commodities. Remember, copper is known as Dr. Copper. It's an economic metal, and the more that this drops, as we stated in the prior video, I believe it was, where we talked about the copper to gold ratio and how it relates and looks very similar to PMI numbers, a chart on a 10-year basis, and so forth. So I just pointing out that too as well. That's all I got for you on today's episode, everybody. Be prepared, because I do believe that we are going to be tagging one of these expected moves, whether that's to the upside or downside, I don't know, but you can pay attention to where price is from a month-to-date anchored VWAP perspective. As we're above it, it's going to be bullish. If we get below it, be on lookout, because we could very well head lower there as well. That's all I got. See you later.